So today we're talking about, is whole life insurance a good investment for retirement? If you've been watching this channel or you're a subscriber, you know that we do love whole life insurance, and there's a lot of other things that we like in your overall financial strategy. But one thing I'm not so certain about is it an investment? Let's get into it today. Whole life insurance, is it a good investment for retirement? I want to clarify something. I don't view life insurance as an investment. I think of it as a storage place, a place that, we can grow our wealth. I think of it as a place where it can provide a tax-free death benefit to our loved ones, right? There's a whole lot of good things that can happen with life insurance. And one of the things you may not know is that you can actually use it as a retirement supplement vehicle, right? A way to create tax-free income for your retirement, a way to supplement the things that you've already been doing on top of your company's 401k, your IRAs that you may have, some annuities that you have, right? It's a really valuable piece that can fit into your overall financial mosaic. So why don't I like to call life insurance an investment, whole life insurance? The reason I think that it's not an investment is because whenever I hear the word investment, I'm thinking of loss, right? Investments always have the inherent risk of loss. With life insurance, and whole life in particular, we have a guaranteed growth component of the cash value, right? So by state law and contract, depending on your insurance carrier, you're going to see, potentially a 3 or 4% guaranteed growth in the contract. So that to me says, hey, that's not an investment because I have no risk of loss here, right? But on top of that, if you're working with a good mutual carrier, you're going to see an additional 1, 2, maybe 3% on top of that 4% because of what? The dividends. So you may wonder, okay, well, what's a dividend? How does that fit into the whole life insurance, and why is it important? It's important because that 1, 2, or 3% can be tremendous growth over a 20 or 30 year period, which you may be putting money away for towards your retirement goals. So that 20 or 30 year period and all that time of compounding growth means a lot in the cash value. So you want to be looking at, okay, this is a long-term contract. I'm going to be saving all of my money. Make sure that you're with a good mutual company, right? One that's been in business for 100+ years, and one that has an A+ or better rating. Look at their Comdex rating. Make sure you're with a company that has a proven track record of paying consistent dividends year over year over year. And so when it comes to the life insurance, the idea of taking a retirement income supplement from it when we get to 65 or 70 or whatever age you retire. If you're 30 right now, you're probably saying, yeah, I'm going to retire at 50. If you're 50, you're hoping to retire at 70. That's just the way it goes. The younger people are, the sooner they want to retire. But reality is most of us are going to be working a long time in our careers. But let's be honest, working a long time in our careers, it's not always a bad thing, right? If we're doing what we love, which I hope that you are, it should be a good, positive experience. And for somebody like myself, I really don't ever want to stop. I say that now. My dad said that when he was younger. I think at some point I will want to stop. But for now, I love what I'm doing, and I want to continue to do it for as long as I can. And I hope that you feel the same way about your career. So back to life insurance, right? So we've chosen a company. We have a good mutual paying company. We're building cash value. We're seeing what it's going to look like in the future, which is really nice with life insurance because you can illustrate. You can see what the guaranteed growth is going to be, but then you can also see what the non-guaranteed, the one with the dividends on top of it. And why is it non-guaranteed? Because no company can guarantee that they're going to pay a dividend. That's why it's so important to choose a company that has a strong track record of consistently paying dividends.
Rob Gill with the Money Minute here. The question is whole life insurance a good investment for retirement? Let's just set the record straight. Whole life investment, not the same sentence. However, proper planning, understanding the products that are out there, the advantages and disadvantages, having a core philosophy, being tied to your goals and objectives, that leads to a good retirement plan. And oh, by the way, yes, life insurance is a Swiss Army knife, makes everything else you do better.
So now that you are seeing what this is growing to and what this can be, you have to think about there's a couple different strategies that life insurance can have, right? One, you have access to cash before you retire. So that's a great thing, right? We have access to cash that we can pull out and put into other investments to help grow our pile of wealth, right? It's how does that get used in our financial mosaic? Some people refer to this strategy as a bank on yourself strategy or the infinite banking concept, right? So we've done more videos on the infinite banking concept. They can probably link to one somewhere on this. I don't know where it shows up anymore, but there you can see more videos on the infinite banking concept and how to design a whole life policy to optimize that. The other things that you can do is once you reach retirement, well, the one thing that people don't think about is how important that death benefit is, right? Especially when we're younger, it's great. We're going to protect our family, protect our income. But when we get to retirement, that life insurance death benefit can actually be an asset replacement value. What does that mean? Think about the fact that most people are saving only into a 401k. By switching and doing some 401k and some into a whole life insurance, they're creating a permanent death benefit. Why is that important? Because when we spend our assets out of our 401k, what we're doing is essentially paying tax on all of those distributions. What else happens? We want to leave some money to our children or our grandchildren, right? And if the only place we ever saved was in that 401k, well, what happens when we leave it to them? That money gets taxed, right? And depending on where the rules are with Congress, they're always changing. There's talk about them even taking and making you pay all the tax in that year, right? So imagine leaving something to your grandchildren and them having to pay a bunch of tax on it. So the idea with having a permanent death benefit is we can spend down all of our assets while we're living, and we can leave that permanent death benefit to our children or our grandchildren or whoever we want to. Maybe it's a charity. The great thing is, for the most part, that's going to go income tax-free if structured properly. If you're looking for more information on how this stuff plays into your overall financial picture and you're not quite ready to talk to somebody yet, click on the link below. Also, we've created a free financial freedom roadmap. It's going to help walk you through some of the different strategies that are available for you. And if you like this video, please like this video.